It is now my distinct pleasure to introduce our guest speaker today, Mr. Luis Martinez. Luis is a startup strategist, venture investor, and innovation leader who has helped over 200 entrepreneurs build and scale companies across diverse industries. He currently serves as the Senior Venture Associate at Capital Factory, where he identifies and supports high-growth startups with strong potential for impact. A former chemistry professor and senior scientist, Luis has bridged academic research, entrepreneurship, and community building through his career. At Trinity University, he led the Center for Innovation and Entrepreneurship, launching over 65 student ventures. As a mentor within Geekdom, Capital Factory, Techstars, Mass Challenge, TechBlock, and more, Luis brings deep expertise in early-stage investment, business strategy, and innovation ecosystems. And he's committed to helping founders, people who are in this room, people who are online and attached to these partners and their programs, helping those founders turn bold ideas into real-world impact. Luis, I appreciate you being here. Thank you so much. The floor is yours.
Thank you so much. Thank you, Marcus. Really appreciate that introduction. Thanks so much for that introduction. It is a pleasure to be with you all here today in the RGV. The presentation, I think, is about to pull up in a little bit. Very excited about the conversation we're going to be having place today, just so that I can set everyone's expectations. You don't want to be out of here by 1, right? That's the goal? Yeah. So we're going to breeze through some slides pretty quickly. And so just be aware that I used to teach this stuff for a full semester, and like I've got like years of curriculum, and you're going to get an hour. So there's a lot of depth that's there. Because I no longer teach at a university, I have to make sure that our lawyers are happy, and so I just want to make clear that I'm not providing any legal investment or accounting advice. Please seek a professional. What you are going to get today is for educational use only. The views and content are not those of Velocity Texas, Alamo Angels, UTRGV, Capital Factory, the governor of the state of Texas, et cetera, and any resemblance to any individuals, live or dead, are purely coincidental. So as we begin in talking about the journey in pitching to investors, the first thing you need to know from your perspective as a founder, and it's really important, is what are you building? Are you building a bicycle, a car, an airplane, or a rocket? So a car is a 7-figure business. It's $1 million business. A bicycle is a 6-figure business, $100,000, $200,000 business. An airplane is a tens of millions of dollar business, an 8-figure business. And a rocket is a 9-figure business, $100 million, billion-dollar business. This is really important. If you are building a bicycle, who here knows how to ride a bicycle? Pretty much everyone in the room, right? Who here knows how to pilot a rocket ship? No, 0, right? So the speed is different for these vehicles. The kind of training that you have is different. The kind of folks that are building and engaging in these things are very different. And so if you're going to be talking to an investor, they're interested in the $100 million kind of business, the billion-dollar business. That's what VCs are interested in. Other investors may do different kinds of vehicles. So be aware of what you're trying to build before you approach an investor. Second, have all the things that you need in order to be investment ready. So if you have an idea, that is not the opportunity for you to be talking to an investor. Have your legal entity up and running. If you are building a rocket, a $100 million business, a $10 million business, or an airplane, you're probably going to need a C Corp. That is the legal entity that many VCs, for example, only want to invest in. You can have an LLC, and those are investable vehicles as well. There are plenty of people who invest in LLCs. There are plenty large companies that are LLCs, but you have to have the proper legal entity. Your name, your logo, your website. Please know @gmail.com email addresses if you're looking for investors and talking to folks in that way. You need what's known as a fundraising deck. We're going to talk about that briefly in today's talk. Social media, LinkedIn or whatever else is appropriate, LinkedIn profiles for your team and your executives, a one-pager description on your business, and then a 10-second elevator pitch, and then versions of your pitch that don't involve a deck. A 3-minute pitch, a 20-minute pitch, a 15-minute pitch. These are all really important. So that means you need to have your legal stuff in place, ready to go before you start talking to investors. These include things like, in addition to your legal entity, founders agreements, vesting schedules, buy-sell agreements, IP assignments, contract boilerplates, the financial registration documents that you need for formally fundraising. If what I've just told you sounds like it's Russian, part of the series includes a lawyer. Please talk to Mac Duke and the other great folks that are talking about those workshops about what these documents are. But these are the kinds of documents that investors will be going through in your data room, and they need to be ready before you're talking to investors. You should also have a bank account and an EIN number in order to take those funds in. And if you've been operating for some period of time, the financial documents, your taxes that are important as well. You want to be positioned before you pitch to pass due diligence. And so some of it is, are you talking to the right investors? And then secondly is, do you have everything that's necessary? At this point, for those of you that are online, for those of you that are here in the room, you can stop paying attention. Because what you want is just this book. Great book, get backed, amazing book on how to construct a pitch deck, how to do a fundraising campaign. If you want to log off, feel free to go ahead and log off if you're online. That's the punchline. Get Backed is the book. Great book to go ahead and get. But it's important to understand that decks and for pitches are different than that for customers. So what you want for a customer is a different value proposition than the value proposition that it is that you need to have as an investor. So as you're spending time in your business pitching to customers, that's an important value proposition. That's why someone will buy you. Your investors need to understand that. But it's a different kind of value proposition for investors. The third thing you need to understand before we get started on how to craft the pitch is know the game that you are playing. 97 to 99% of businesses do not need venture capital. It is a small minority of businesses that will be talking to VCs. It is those companies that are looking at $100 million, billion-dollar businesses. Those are the kinds of businesses that are investing in VCs. There are a whole range of other investors out there as well that a vast majority of businesses access, but understand the game that you are playing. Also, as I'll talk about in the series, the best kind of investor your company can have is called revenue. So build a real business, have revenue, make profit, you can bootstrap your business. There is nothing wrong with making money. It's even better if you're making money proving to people that your business model works and that your business is doing what you want it to do. Fourth thing that's really important before you speak to an investor and how to craft that pitch is how much are you in for? Have you invested your own time, your own effort, and yes, ladies and gentlemen, your own money in order to make your business work? You can't expect an external investor to put in more of his or her time or more of his or her effort or more of his or her money than you have as well. So, hey, I have this idea. How much money have you put in or how much time have you put into the idea? Well, that's why I'm talking to you, Mr. Investor, is not the way to approach a pitch. They need to see that you've got skin in the game to make this business a working business. Now, many people think investment is just money, and that's important. But there's lots of different kinds of investment that investors make in your business. There is money, but there's also those that invest time and those that invest effort and those that invest money and time and effort. A way in which you can think about time and effort are things like mentoring, advice, connections, knowledge, wisdom, experience, credibility, kind of important, customers, as well as their effort in making the business run. So as you're looking to make the pitch, what are you interested in? Only money? Money, time, and effort? Only time and effort. Sometimes the time and effort an investor spends with you can be more impactful than whatever dollar they bring to the table. And that's important because investors are way more than money. They've seen lots of companies. They have a deep set of experience. They have wide networks that they can pull from founders, from ventures, from other investors, from service providers, from customers that they've worked with that are associated with accelerators or incubators. They also have lots of other connections and interests. Some of them which are represented and are expressed. They're alumni for a certain college or university. They're associated with certain angel groups or associated with certain accelerators and incubators. Others are just their network, people who they work with, people who they know. 20 years, 30 years, 40 years of experience, 10 years of experience in working in an ecosystem and working in a field. So it's really important to understand that it's more than just money that you're trying to get from investors. You also need their time and effort. Also, when you're pitching and talking to investors, they're not Santa Claus. They don't give money away. They don't care if you're naughty or nice. They don't deliver exactly what you want on your Christmas list, and they don't deliver magically overnight exactly what you wanted under the Christmas tree. They are, however, always watching, just like Santa. So it's really important to understand who they are and why they're doing what they do. And fundamentally, investors are investing money to make money. That's it. However, there's lots of ways in which investors can invest money. They can invest in the stock market, they can invest in the bond market, they can invest in real estate. They're looking at investing at private companies because that rate of return should be higher than the other kinds of investments that they'll make. So these are investments that these investors are making, typically as part of a balanced investment portfolio that goes to those companies that are high return, but also high risk. So just doubling their money is not going to cut it. They're looking at higher returns compounded yearly that is typically in excess of whatever you would get in investing in public equities. And there's different kinds of investors that are out there. There's obviously friends and family, there's angels, there's VC, there's private equity. I'll talk about those briefly. But there's also other ways in which we can get investment. There are crowdfunding platforms such as equity crowdfunding platformers such as WeFunder, product crowdfunding forms that are so known as Kickstarter. And finally, customers are great ways of making money for your business. Like, a dollar's a really great dollar when it's coming from a customer. Partners, vendors are great sources of investment, as well as competitions and grants. So don't think that your only kind of investors are people that are just VCs or just angels. So the first most common source of investors that are out there are friends and family. Make it formal. Make it a formal debt or equity kind of transaction. It's quick, it's easy. It can be a formal agreement, a promissory note. Sometimes it's informal. If it's informal or formal, Thanksgiving might be difficult. Hey, I invested in your money, in your company. It's been 2 years. Where's my money? Oh, Dad, we're just sitting down. We're having turkey. Yeah. Happy Thanksgiving. Where's my money, right? So be careful with friends and family, but these are typically the first places where businesses are looking to get that. They're investing in you as a friend or family member because they know you, They're your brother, your uncle, your cousin, their nephew, their grandson. It's because they believe in you. It's because they want to see your dreams come true. Yeah, they'd like to make some money back, but it's really about investing in you as a person. Angel investors are often successful exited entrepreneurs, business individuals that are active investors. They like to invest typically in early stages of companies. Their first dilutive fundraising round typically, which is known as sort of a pre-seed or friends and family round, or the second round of equity equity raising, which is a seed round, some as much as sort of the third round, which is an A-series round. They are formally accredited investors. That is an SEC definition that says that their net worth is north of $1 million, and they understand the risks of private investment and can do the due diligence themselves. And many of them are investing their own money. They are not professional money managers. What you need to know when you're pitching angels is what is their niche or their interest? Are they only interested in companies in RGV? Or are they only interested in companies in Texas? Or as angels, and I made my money in real estate, I'm looking for prop tech or real estate tech, or I made my money in oil, I like oil, I know energy, I'm interested in energy ventures. So many angel investors will draw from their own professional experience because they have a knowledge of an area, they have a knowledge of an industry, or they have an interest in a particular area or an interest, and they're investing their own money into your company. Venture capital firms are investing other people's money. We go around, we gather those commitments from limited partners, and then we invest in companies afterwards. Some VCs do invest first dollars in companies, but they're a minority. A majority of VCs like to invest sort of at that second post friends and family raise. Some do pre-seed formally, which is less than $1 million, less than $2 million total raised. Most will do post that. And what they're doing is they're looking to target a group of companies and are looking for that company and that group to grow. And they're looking at high risk, high reward, early stage growth companies. Typically, these are technology companies. There are some VCs that do invest in B2C because they see that opportunity. There are some companies that, some VC firms that invest in other areas as well. But you're looking at tech companies that could be hard tech as well as software, space, aerospace. And what they're doing is they're purchasing equity. They're not taking debt. They're making an investment in the company. Here is the kicker. They're looking for a return on their investment 5 to 10 years when they're making that investment. This is why that first analogy that I said before is really important. They want a rocket. They want to have a $100 million, billion-dollar opportunity in 7 to 10 years. If you're looking to build a $1 million, $2 million, $3 million company, that's fine. But most VCs will not invest in that opportunity because they're looking for an investment horizon in 5 to 10 years that has that level of magnitude of speed of exit. Why? Because those investors get paid when those companies either go public or they get acquired. And they want that acquisition to happen or that IPO to happen within that kind of window. So if your goal is to build a sustainable business that you're going to carry in your family for generations, that is not VC investment. That doesn't mean there aren't investors for you. That's just a different kind of company. So understand the game that you are playing, particularly if you're thinking about VC. It's got to be a scalable and capital efficient business where the valuation and the business opportunity is measured in the tens of millions, in the hundreds of millions, in the billions. This chart's really important. The TAM, SAM, SOM slide, the total addressable market, the serviceable addressable market. Those kinds of things are incredibly important because these are the things that for VCs have to be in the tens and hundreds of millions of dollars. They get paid at the exit event, and they also know that 9 out of those 10 companies are not going to be a successful return on their investment. So, if you just look at all businesses and all startups, 7 out of 10 will fail. Of the 3 that remain, 1 will be operating at a loss, operating break even. So for a VC, that's also a 0. A second of that remaining alive company, right, will roughly be break even, maybe be slightly profitable. Might be a 1x exit, a 2x exit, a 3x exit. For a VC, that is also a 0. That last remaining company, that is the one that returns all of those 10 investments and return on top of it. And that's a 10x, 20x return, 30x return, 40x return. So that's the game you're playing if you're seeking a VC. And also, you will get diluted in your company as that progress progresses. For example, if you look at Facebook, the founder ownership of that company ended up at about 31%. So the range of dilution that happens depends upon how many rounds you raise, what that sort of valuation is of the company, how much of the company that is that you do sort of raise at every round. But if your intention is to hold 80% of the company, 90% of the company, or greater than 50% of the company, if you can look at these numbers, then you are not playing the VC game. You're playing something else. You will be diluted through the course of going to the public, to the private markets once, twice, 3 times, 4 times, etc. The last thing before we get straight to the pitch stuff of the things that you need to understand before you go pitch to somebody is that there's lots of competition out there. There's a competitive landscape of lots of companies out there that are potentially doing the same thing that you're doing, or that were doing the thing that you're doing, but they no longer exist anymore. Or they might have pivoted into doing something else. You need to know what your competitive advantage is. What can you do that your competition can't do? Or what do you do that your competition doesn't do as well? Or what do you do that's different from your competition in a fundamentally different way? There's also adjacent solutions that you may not think are competition that are called competition, right? How will you win in a specific sort of value to your customer or as a company? What is your superlative sort of comparison? We're the best at, we're the unique in, we're the prime number 1 world's example of. Where is that? And there's also traction. Your traction as well as other companies' traction, as well as the market dynamics and change that happen that are both macroeconomic. Are we in a recession? Are we going to a recession? Are we going through a period of inflation? Are we not going through a period of inflation? As well as microeconomic as well. So all of these aspects impact and influence not only your ability to operate your business, but more importantly, the likelihood that an investor will invest into your business. And remember, you can't just be 30% better. You just can't be 2 times better. We're looking as investors at those opportunities where they are at least 10x better than what the alternatives are currently. And what does better mean? Better can be faster, better can be cheaper, but it doesn't have to be necessarily those 2. And then remember, as you're going through and you say, no one else is doing this, we have no competition, that's just simply not wrong. The current status quo is your competition. And so understanding the dynamics of what that competition are important before you go out and pitch your investors. All right, so you ready for the secrets? Here we go. All right, here we go. There's a lot of stuff in the next slides. There's a lot of stuff. So pay less attention to reading the slides and pay a lot of attention for those both at home and here on what I'm going to be talking about. This is what's very interesting. This is really hard. Super hard. It will be very challenging. You'll be talking to lots of investors. How many investors? Count them in the dozens and potentially in the hundreds. You will get lots of no's. You will get a lot of, you were too early. You will get a lot of, you don't fit our thesis. You get a lot of, we don't do that. You're going to get a lot of no's. Look at every opportunity that you have to pitch to someone, to talk to an investor as a way of sharpening your pitch, of sharpening your message. And it's really important that you think about who those strategic partners are in helping you with this journey. Dilutive fundraising, which is what this kind of equity fundraising component is, means giving up equity. So those folks on your cap table, whether they're formal investors or advisors that are investing time and effort on your business, right, have to share your vision, have to add value to the work that they do. And they should not be people who just invested time with you 7 years ago and are no longer active, or just participated and helped you with something out 3 years ago and they're no longer active, or a former founder who's no longer active. They've got to be people who are walking with you through the journey all the way to the end. Second, so it's hard. Number two, you need a story. You need a hook. You need a reason why I need to be continuing to listen to you. So grab a hook. And it's okay to make it personal. It's okay if you yourself have experienced the problem that you're seeking to solve, or if you're advocating for a stakeholder, if you're advocating for a customer whose problem you are obsessed about solving. And we are wired as human beings to tell stories. So it's okay as part of your journey to paint the story of what's going on. So here's the basic structure that if you did not log off and you're still logged on, you will find in the book, Getting Backed. The first is, there's sort of three major sections. The first is like, what is the problem and what is the solution? And I'll talk about this briefly as we go forward for the remainder of our talk. So like, what is the problem and solution that you're trying to solve, and how you're solving it? Second is like, what is the market and the business model? How you make money? How you approach that market? How will you do what you do? And then the last part is, who's your team? What's your traction? And ultimately, what's your ask? So let's go to sort of like a first slide, or one of the first slides, right? The problem. It's really important to help you get investment is to articulate the problem to your investor clearly. And that's the problem you are hoping to solve. So it's a clear pain point for somebody. It's a pain point that's so painful enough, people are willing to pay money to solve that problem. Very important. Number two, who's affected? What's their experience? What's it like? When one is talking about equity in healthcare, when I was talking about impact in healthcare, I don't want to diminish how important these health problems or health challenges are. They are. They are what you're trying to solve. But that impact and who's affected are important. It's important to understand how your solution will solve that problem for them, but ultimately, someone's got to pay for it. So saying we're going to be able to reduce people's diabetes, or saying we're going to be able to improve people's longevity, or people to say we're going to improve people's health outcomes is important. Those are important problems to solve, but in that problem, somehow you're going to solve that problem and make money for somebody. So it's really important to articulate that as well. I'll talk about that briefly in the next couple of slides. Also, the urgency and the impact is critically important as well. So yes, you're targeting something, but have people understand what the stakes are. And in many cases, they're life or death. Now, the solution is your big idea. It's how you're going to sort of solve that problem. It's the method by which you're going to alleviate that pain. So you're the hero. This is the hero of the story. And what's important here in your solution is what is the unique value that you're sort of offering in solving that problem. What makes you special? What makes this solution better than all the other solutions? What's innovative of this approach? What advantages set you apart from all of these things? Visible.vc, for example, has got some examples of great ways of creating top-notch sort of presentations. I included that in the slide as a shout out, but also keep it super simple. Right? In explaining your solution, well, we've got this part over here, and like they pay these people, and these people like provide this thing over here, and then what they do over here is they produce this thing over here, and then these people over here buy this thing over here, and then after they buy this thing over here, they use it for these people over here, and then these people finally like get their diabetes cured. That's just too complicated. Too complicated. Keep it simple when you're pitching investors. There are opportunities for them to dig deeper. Market potential. What's your target market? Who's the customer that it's out there? Diabetes patients. Are they paying for it out of pocket? Well, no, those are the folks that are impacted. Well, then who's paying that? Doctors. Are doctors paying for it? Hospitals. Are hospitals paying for it? Kind of. Insurance companies are insuring. This is what I mean. Like, who is the target market, not only of who's impacted by diabetes, but also who will be paying for that solution. And I give you some examples in that kind of quick story, or that search of who the answer was. Is this a doctor solution or a medical professional solution? Is this a healthcare system or hospital system kind of solution? Is this an insurance kind of solution? Is this a Medicaid, Medicare solution? Is this an out-of-pocket solution? What is that target market, not only of the oncology opportunity or the diabetes opportunity, but ultimately how much dollars are actually being spent in that market to solve that particular problem are really important. And then even then, diabetes, right? What's the beachhead segment? Diabetes is pretty big, right? Is it diabetes for predominantly Hispanic populations in South Texas? Is that your beachhead? So thinking thoughtfully about where that initial focus is critically important in what that go-to-market is. Because we're going to look at this challenge here in South Texas for Latinos, and then we're going to look at Latinos across the state of Texas, and then we're going to serve all diabetics. And that's the growth potential of the story that you will tell as part of that market opportunity. So look at those highlights of how you'll be going from a beachhead, you land on that beach, and then you expand to sort of approach the overall true market opportunity. Next slide. It's all right, it's not going. Great. Now, I don't want to say it's the most important part, but this is where we get into the detail of how you do what you do, which is, what's your business model? How are you going to make money? It's very important that while the health impact is articulated, you are helping infertile couples get fertile again. You are helping cancer patients get cured of their cancer. It's really clear that you understand how you will make money. Who pays? How will they pay? How will you earn revenue? How will you get paid? Do you get paid per patient? Do you get paid per procedure? Do Do you get paid per test? Do you get paid per hospital? Right? Understanding that monetization strategy is really important. But also, how will you fundamentally scale? How will you scale that business from one patient, one doctor's office, to hundreds of patients and hundreds of doctors' offices, to millions of patients and millions of doctors' offices? That's incredibly important. As well as your go-to-market. Like, how will you initially be going to market? Are you already working directly with a group of physicians? Or do you have an important clinical insight? Or do you have an important sort of customer insight because you're trained as a nurse or you understand something about billing? So this aspect of how you will acquire customers, how you will gain traction is critically very important. And then we get to the traction component. And this is perhaps the most misunderstood aspect of when entrepreneurs are talking to investors. You need to have some level of like real validation. And sometimes the best validation is $1. If you can sell your thing and someone's buying your thing, and you're doing the thing that you said that you're doing, that's a really important validation. Show it off. If you've got actual real customers, if you're actually selling a product or selling a service, even if it's not perfect, even if it's at a super small scale, it's really important to show what those program results, what that revenue is, what those noteworthy partners are as you build that business. It proves that what you're telling me on paper should work is working. Traction reduces risk for investors. Traction shows me as an investor that that's a likelihood of a business that's going to be successful. Because remember, most of them are going to fail. Given a choice of company with traction, company with no traction, guess which one investors will choose? Traction. So get traction. Milestones are really important. Sort of what are the milestones that you've achieved, the milestones that you've hit? Maybe you don't have revenue and customers yet. That's okay. If you're pre-launch or pre-revenue, are there other proxies for traction that are milestones for you as a company? We're going to partner with this hospital in this setting, under these conditions, with this group. We will do this for 12 people. And then after we've done that for those 12, we're going to expand it to 36. And then we're going to expand it to 50. It's at 50 where we start getting paid to do a pilot. And then we move from that paid pilot to an actual contract. So staking what those milestones are for you as a business and showing what that traction is critically important for success. Your team's also super important as well. If you are a founder who is working as a solopreneur, that is awesome. But it's risky. What happens if you get hit by a bus? What happens if you get bored and you want to do something else? Or this gets to be too hard and you want to do something else? So you need a team around you. And this is more than just, this is the tech guy who's building the product. That's important too. But you need to sort of have a sense of an understanding that that risk is mitigated by more than just one individual. And also, it's important that the people that you are on this journey with also understand that they're going to be pirates just like you. And everyone on the team has to do what they all have to do in order to make this successful. And if it means walking on fire, all the team will walk on fire. And if it means eating glass, it means the entire team is eating glass. So the team that you build at those first 0 to 1 stage, and their mindset, and the culture that you set up are critically important. But it's also really clear that you don't have everybody that you need, and you won't have everything that you have filled. And so you will also want to have advisors or mentors that you can tap into to help you understand or know or do the things that you don't have done, or that you have gaps. Acknowledge that you have gaps. I don't have a guy to build the product. I want to use your money to find the guy to build the product. That's a gap I've identified. And oh, by the way, here's the person I think I've identified I want to hire to make that thing happen. Right? They've got experience in doing that. I know they're the best because I vetted them. Here's examples of their work. I've put a little bit of money in to help get them started, but I need your money to ensure that that occurs as well. So it's okay if you let investors know that not everything is ready and not everyone is on board. We get that. You're early. But have you thought through where are those gaps? Are you wise enough to understand and know where to go when you're trying to fill out your team? I promise about another 2 slides and then we're done. Competition, as I mentioned before, is really important. I'm not going to dive a little bit deeper into this in this slide, but what I will say is really clearly articulating your competitive advantage is the most important thing when you talk about the competition. Because, like, how will you win? What is your edge is really a defining point for why your business is better. If you're just like everybody else down the street, well, then give me a reason why you're different. So it's really important to do that. That includes the big players, right? You can't ignore the fact that there are big players out there or that there are the dominant market holders that are out there. You need to understand that industry well enough to be able to address how they will either help you or how they might be partnering with you or how they might be hindering you in being able to achieve the success that you want to achieve. And then I think I got one more slide, yes. And then finally, we've got your financials and your funding needs. So your numbers are important and your financial projections are super important, but they're garbage. They're garbage. How do you know what's going to happen in 3 years? I mean, did you know what was going to happen today 3 years ago? I don't think anyone would have guessed what's happening today 3 years ago. No one would have. Same thing is true with your financial documents. It's important you write something down. It's important they have some semblance of reality. So don't ignore them. But what they are is important because as an investor, you and I are going to go back and forth about where those numbers come from. And you have assumptions about how the world will look like and how what your success will look like as you build that financial model. I might agree or disagree with those assumptions. And it gets interesting in us discussing whether or not realistically you're going to grow 100% year over year. Is that realistic? So the numbers are important. Your projections for your company, your revenue, your burn, your growth trajectory are critically important. But it's really the underlying assumptions and how that model is built and the way in which you defend or are open to how that model will change in a conversation with an investor that's critically important. The next thing that's important is what is your burn and what is your runway? You should know how much money you are currently burning in your business and how much runway you have before you have to shut the doors down. No investor, well, I take that back. If you are 2 months in and you only have 2 months of runway left, and if I don't get this investment, I'm going to shut my doors, investors know that desperation. So know what those numbers are, but they're going to want to know what those inflection points are. What does that investment give you with regards to runway, with regards to milestones? So it's important to understand what those metrics are for your business. Investors at varying levels of sophistication we'll ask you about these numbers, right? And then finally, what's your ask? What are you asking for? Are you asking for $750,000? Are you asking for $2 million? Are you asking for $500,000? And you want to articulate, A, how you will use that money. We're going to use $1 million for product development, $500,000 for sales and hiring, another $500,000 for pilot expansion. But more importantly, this is where people screw up. What are the milestones that get unlocked when that investment dollar is made? Right? I'm going to spend $1 million for product development, and we're going to go from a beta version to our production version. We're going to go from our current version that is working to this new feature that's going to unlock an additional 2 revenue streams, right? We're going to spend $500,000 on sales hiring, and that's going to generate $5 million in sales. That's a 10x return, right? So those milestones that are enabled are perhaps more important than your pie chart with 30% here and 20% here and 70% here. Very important to understand that in your financial needs. We're wrapping up. Rehearse, practice relentlessly. You should always be practicing your pitch all the time to every investor, every mentor, every person who will hear you. You need to know it by heart, and you need to be able to know to pivot. You need to be able to pitch your company in 2 sentences or less. As you're going down an escalator and someone's going up an escalator, you should be able to pitch your company when the doors close in an elevator and you push 5 and that person pushes 3. You got 3 floors to be able to pitch your company, literally, in the elevator. You've got a 30-minute meeting. You've got an hour-and-a-half meeting. You've got to have practice in pitching your company over and over and over again. And oh, by the way, you want to have people that are kind of super mean to you, that ask you really hard, difficult questions, that tell you your baby is ugly. Don't get mad at them. Ask them to help you. Tell them, please, be merciless, be mean. Because you're going to get mean questions, and you're going to get people that are not going to be nice to you, and you're going to get people that are going to ask you very embarrassing things. Better to do that first with friends or mentors or advisors or fellow founders and have an answer for when you then have it with an investor. So rehearse all the time. Get feedback all the time about your pitch, about your business, about the fundamentals of your business, and then revise your business model, revise your deck, revise what you were planning on doing based upon that feedback. It's really important that if you're like, wow, that's a really good idea, I hadn't thought about it that way, you put it and change it and put it in your deck. And then you try that out. And you're like, that guy didn't know what the hell he was talking about. We're going to change it back. Or, wow, he had a really great insight. That really unlocked a lot of more meetings, a lot more interest. Wow, I'm going to go and ask him that same question again. So it's really important to seek feedback and then try it out. And be prepared for questions. Every slide, everything you write down is something someone will ask you a question about. But also, you have to make the assumption that they know more than you do, and you have to make the assumption they know less than you do. You don't know. So don't fumble about answers. Be able to pivot or adjust up or down on the level of complexity and sophistication. You will talk to them about how special your special sauce is, or how basic you need to be able to explain your special sauce is. So knowing the details and being able to adjust based upon your customer is critically important. Last 2 slides, address investor concerns proactively. Acknowledge the risks, the holes that you have in your business model, especially when they mention it. And most importantly, how will you address that? Show that your business can scale. And it's okay to exit. That's how investors make money. You should say that you're excited about exiting. You have some ideas about where that exit might be to. You should have some thoughts about what the timeline is for that exit. That helps me as an investor benchmark whether or not your reality reflects my reality. But to go on and say to an investor, I'm planning on building a business I'm going to pass on to my kids, that is not a VC. That is a different kind of investor, perhaps a friend or family, as opposed to an angel or a VC. Make a business case for your impact, for those of you that are impact driven. Remember that it's an intersection of your mission and the goal that you want to achieve and the market that takes place. And be able, as I mentioned before, to tailor your pitch to understand the priorities. Are we having a moment and vibing on the impact of what we're going to be doing for women? Because it's an impact, femtech, women's health concept. Or are we vibing on how it is? This is a great business, and we are going to be the dominant solution for all of women's health. You're going to need to be able to tailor that pitch depending upon who your customer investor is. And then finally, present. I want to make sure that I sort of close on a positive note. Stay resilient. It's really important because this is hard, that your insight that you're going to have will be the transformation that we need in the world. Believe in that vision, but don't be an idiot. The world is going to be this amazing thing. It's going to be incredible. We're going to change the world. It's we may not have an FDA anymore, right? It's yeah, you're right. Right? Be realistic and be open to the kind of pushback that you'll have about the vision or the changes that are taking place. So it's really important to believe in the vision of the world that you want to make, but also understand that as people are giving you feedback or as the environment changes around you, that you're able to modify that vision to be able to take advantage of that chaos, take advantage of that uncertainty, take advantage of that change to bring forth the kind of vision you want to bring to the world. And then finally, go make that happen, man. I am blessed that I get to work in my day-to-day life with amazing founders like you, and I'm blessed that I get to walk alongside many of them as a mentor, as an advisor, as an investor, in helping them achieve the kind of changes they want to make in the world. And that's something that excites me. So let's go build together. Thank you so much.
Don't go anywhere.
Don't go anywhere.
Don't go anywhere. So I know that we're running long. For those who are online, if you could please just entertain us for a few more minutes.
All right.
As Luis said at the very beginning, it's quite difficult for the professionals that we have participating in this series to try to encapsulate multiple decades worth of experience into 1 hour, and really kind of less than that because we do want to have question and answer. So we're going to run a little bit long. I promise you it's worth it.
All right.
For those of you who have questions in the room, we have the microphone. If you have a question online, please put it into the chat and we'll make sure that we get it. Anything on the chat, Nicole, in the room? Okay, so while you're thinking,
I have a question.
Please.
Yeah, Luis Martinez, founder.
Yes, Luis.
Yeah, Luis, go right ahead. Yeah, so I'm thinking about going out and raising money, and people tell me, what does the current fundraising environment look like in 2025? How is this the same or different from previous years?
That is a wonderful question.
That's a really great question, Luis. Thanks so much for asking. So where we are today in 2025 is actually kind of very interesting. It's sort of like Groundhog Day. So I think the year started with a lot of enthusiasm for venture, a lot of enthusiasm for investment. The sort of uncertainty of the election had been sort of resolved. We saw the stock market sort of have sort of an epic sort of beginning to 2025. I think where we are now is people being a lot more cautious. So we're finding investors that are perhaps scaling back some of their projections. We may be going to a recession. Consumer sentiment numbers came out earlier this week. Business sentiment numbers came out this week. They're at a pretty low point for 2025. So I think 2025, conservatively is going to look a lot like 2024. Probably not as bad as 2023, late 2022. But I do think that there's still a lot of optimism. Investors are eager to invest dollars. This is probably still the best time to build a company. And so if you have a vision to build boldly, please do that now. I think if you're in the game already and you've already done your first fundraising round, or you're about to enter your second fundraising round, you've been in this game, it's tough times. Focus on the fundamentals. Focus on building a real business. Focus on generating revenue. Focus on hitting your traction. Look for opportunities to partner and collaborate. Look for opportunities to take advantage of sort of this uncertainty. But that's a really sort of important thing. So things are sort of very much like they were last year. So if you thought things were super easy last year, well, congratulations, they're super easy for you again this year. If you think things were kind of hard, things will continue to be hard going into 2025. Thanks for that question.
We do have a question in the chat.
Awesome.
What does that initial door knock with a VC look like? How receptive is a VC to contact outreach, cold calling basically, or is there a secret door to open?
The secret door, I'll start with the secret door. The secret door is called a warm intro. So it's really important to have a warm intro. Many VCs, we all know each other, everybody knows everybody. And people who don't know each other are within one order of magnitude of knowing somebody else. So a warm intro, either from a founder that's already been funded by that investor, or other people within that network who knows us investors, are easy. Now, I don't want to say that's the only way to have that first knock on the door. I get inundated daily by dozens, if not hundreds, of cold calls and cold email requests and cold DMs on LinkedIn. That is a viable approach. What I would suggest is the secret for those is just be really clear. Be really clear that you're seeking investment, at what stage you are at a company, if you've got any traction or any revenue or whatever your current state of your product is, clearly state that. And then how it is, if you've got a deck, you should be able to formally send that deck to an investor or have a way of sending that deck to an investor. And I understand some of the sort of pushback. People say, "Oh, no, I don't want to send investors' deck. I'm going to send that to all of my competitors. And here's a story, and here's a story, and here's a story." Listen, look, that's like the lingua franca. That's how investors evaluate deals. And if you are not willing to share your deck in that first intro, or not willing to have me review your deck before we take a meeting, before even I decide to take a meeting, there are others that are, and there are others that will. So just understand that this aspect, it doesn't have to be the confidential deck. It doesn't have to be the full 11-slide deck. You can give me like a 3-slide outline of what's going on. What's the opportunity? What's the market? What's your traction? What's the ask? And it's easy for us then to determine whether or not that will fit in our investment thesis or won't fit in our investment thesis. But really, the most important question that I think that is underlying the question that you're asking is sort of where I started. Have a targeted, focused ask to an investors whose thesis you fit. And that involves a lot of research on your part. What kind of investments does that firm make? Are they in that area? Are they in that strike zone? The kind of blind email to 1,000 investors will get some response occasionally, but really targeting, we do women's health, we want women's health companies, I do women's health, you're going to be my investor, or we do B2B SaaS, I'm a B2B SaaS company, you're going to be targeting an investor for that point. It's really important to kind of have your homework done on who that investment firm is, because these kind of long blast emails are really easy to go to spam. They're really easy to disregard. Because again, I see between 10 to 20 deals a week. And these are meetings I take. Like, of all of that intake I see, I'm scheduling between 10 to 20 founders I'm meeting personally with a week. As a firm, we're meeting with anywhere between 50 to 300 companies a week. So I think it's really important to sort of understand that you've got to sort of be the signal in that kind of noise. And so warm intros are the easiest way. Targeted communications with the materials that you have to show where there's a potential for us to have a conversation. And then I think it's also important to understand, like, just because you have a meeting or just because you have an email exchange is not a guarantee of investment. So your goal is, yes, to make your company investable and get an investment. But understand that will not happen on a first meeting. And that will not happen on a second meeting. And that may not happen on a third meeting. Like, there is a process to how this works. And it doesn't matter if you're talking to VC firms or if you're talking to your local angel group, there is a process. And so understand that that process exists and that you've got to go through that staging in order for that evaluation to be important. And I hope that helped answer your question. Lori.
I have a couple of questions. So in the beginning of the presentation, you pointed out what an angel investor invests in and what a VC invests in. And I'm sure you hear people or founders using VC and angel investor interchangeably.
Yes.
And it is very, very different. To the group, I think it might be important to say, and you did mention about the VCs, but what kind of valuation is a angel investor looking at, and what type of valuation is the VC looking at? And then a second question is, you mentioned about you need to know the investor's investment thesis, what that is, and who they're investing in. Is there a way that people can find out who they're investing in? What would you recommend for the founders to figure out who they're investing in?
That's an excellent question. So I'll answer the second question first. So the way to find out how people are investing and what they're investing in, it's on their webpage. So go to the webpage and see who companies we've invested in. Like, many investment firms, many angel groups will happily tell you who their investments are. There are sort of for-pay databases as well that people look at. There's Crunchbase is one of them. There's PitchBook is another one. They are by no means the only ways in which you can get that information. Deal Room, for example, has some aspect of their platform which is both public as well as sort of paid. So researching, that investment, Googling and seeing Alamo Angels investments, you'll see who they invest in. So that's the first place to look. With regards to your second question about valuations and what they're looking for, my answer is a little bit more nuanced. And so here's a nuanced way of thinking about it. Angels are kind of all over the map. They're investing their own money. And I know a guy who got a $50,000 check after breakfast in San Francisco because it was his own money. And he was like, well, this is really interesting. This is great talking to you. Here's a check. I know an angel investor who wants to spend at least 6 months getting to know his investment before he makes the investment. Now, the guy who spends 6 months, he'll do any deal up to $2 million on his own. And he wants to be the first and only investor. So he wants to know you really, really well in the business, really, really well. So angels are kind of unique. There's a range of sort of what they do. Generally speaking, and you can correct me if I'm wrong, because I probably will be. Angels historically have liked to have been in rounds that are $1 million or below, valuations that range anywhere between kind of 1 to 5, 1 to 10 million, where there's not a lot of sort of traction or initial signals of traction. We're seeing in the current investment environment that changing pretty radically, where we're seeing angels invest in valuations of companies that are north of 5 million, that are north of 10 million, that are looking for monthly recurring revenue and recurring revenue that's in the 5-figure, 4-figure, 6-figure region. And so many angels are now investing in what formerly was used to thought of as sort of seed stage. But there's also angels that kind of invest in seed stage as well. So angels are kind of like all over the map. Like, check size for angels will range anywhere between sort of a minimum of sort of $25,000 per check. I know angels that'll do up to $1 million, $2 million themselves. So there's a wide range of kinds of angels. If you are thinking about angels, you as a founder need to lead, not with your pitch, but with questions. Hi, it's a pleasure to meet you. You're an angel. Tell me a little bit about your investment thesis and your investment philosophy. What do you like to invest in? What kind of check size do you write? At what stage do you like to act? Great. Now knowing this, I can modify my pitch to address that specifically. So it's really important that when you speak to angels, you start with the question of sort of pre-qualifying yourself to see if there's a potential match, because they're all over the map. The other thing about angels that's really interesting is some of them will invest independently on their own. It's my money. Others will invest in a syndicated deal in a special purpose vehicle. Me and a couple of friends will all get together, we'll budget some money, and we'll invest in that deal. Or us within an angel group will invest in a deal. And it's not up to me, it's whether the 4 of us or 6 of us or 12 of us all agree that we will participate. And then there's other angels that participate as formal angel groups, and then it's what the angel group decides what we'll pitch, and then I might write a personal check, or collectively we kind of all come together, or we have to meet some minimum threshold of the number of people who have to participate. So angels are all over the map, all over the map. VCs, it varies. There are some phenomenal, incredible pre-seed VC companies that love to invest in companies and valuations that are typically $5 million or below. They like to invest in fundraising rounds that are 1 to 2 million or below. Some like to take up as much as 3/4 of a $1 million round, or as much as 1/3 of $1 million round. So VC firms are being much more thoughtful about what is that total round size, what's the valuation, how much is my participation going to be as part of that. And then VCs are also looking for that additional signal. So you need to understand when you're talking to VCs, the most important first question you ask when you speak to a VC is, are you a lead, or do you lead, or are you follow-on capital? Because there's many firms out there that are follow-on capital. They require a lead investor to set the terms, of the valuation, to set the term of how much money is being raised, and then other people will follow on to that. And then there are those firms that say, no, like we're happy to lead, or we do lead, or we lead on occasion. And they're the ones who are responsible for majority of the diligence. They price the deal, and then ultimately take a significant part of that particular fundraising round. So know who you're speaking to, understand what their philosophy is and whether or not they lead or they follow on, and then proceed with your pitch accordingly. Did that answer your question?
That did, and there are probably 6 more presentations that you can do.
Yes.
To answer all
I have a whole, I used to teach a course in VC. I have a whole semester on it. Other questions?
Yep, we have another question. This is in reference to your thoughts on the likely reduction of federal non-equity dilutive funding for early stage, high risk, low TRL ventures. Do you foresee a segment of investors addressing this new gap by engaging in ventures with a higher risk profile?
Yes and no. There's a small group of investors that'll take advantage of that current opportunity. But with the current macroeconomic environment and the lack of significant exits in the current sort of VC market, until we see the realization of those paper gains to be real sort of distributions per investment, I don't foresee a lot of private investors filling that gap. If you are a low TRL kind of company, TRL level 2, TRL level 3, TRL level 5 even or below, although from like 5 and above it gets a little different. You need to figure out like how you're going to survive. There are federal grant opportunities that are available, but it's a mess and there's a lot of uncertainty. So figuring out how you can get those kind of research dollars or non-dilutive dollars are going to be really important. It's added a lot of uncertainty at sort of that beginning stages of where companies have gotten capital. For what we do as a firm, we see a tremendous opportunity around military dual use. We see a tremendous opportunity around hard tech, frontier tech, and so we're very bullish on those opportunities. We see the unique way in which some private foundations are stepping up into that space is important as well. But there's a lot of mouths that are looking to get those kinds of dollars. So it's going to be very competitive if you are dependent or if you're looking as part of your sort of corporate strategy to build your business around a significant amount of non-dilutive capital coming from grants. If you've positioned your company in the current market environment around sustainable jet fuel and EPA requirements and climate transition and climate change, things are going to be very, very hard in the next 2 years based upon the current political environment. Question here and then question here.
Great presentation. Thank you very much, Luis.
Thank you.
Talking about the artificial intelligence space, what are you seeing now? Because the speed of changes in this area are very fast, and sometimes you find that something that you maybe are developing, it has an expiration. It has already expired. No? So what is happening now in this area?
AI is hot. AI continues to be hot. AI continues to be frothy as an investment opportunity. I think that a lot of the bets on AI have already been placed. So if you're coming to the AI game as a founder late, at this stage, it's really understanding how you fit in the overall ecosystem of how that venture space is sort of built out. It's pretty built out now. I think there's some very interesting areas where there's gaps. I think I'm excited. I'm personally excited about some of the applications in AI that are building their own models, that are taking advantage of very unique insights that can only happen in sort of part of their special sauce. If you're like a wrapper for ChatGPT, that's hard. That's hard. Now, that being said, I'm old enough to remember, when cloud computing was a thing. Before now it became kind of ubiquitous. I believe that similar to sort of the evolution of that space with AWS and Azure and Google and sort of cloud computing, that we will see a similar dynamic in the tech stack for AI as well. So you'll see people who'll be building on a Gemini tech stack or building on a Grok tech stack or building on an OpenAI tech stack. I think that will continue to happen. So if you're building an AI, you need to be able to answer the following 2 important technical questions. The first is, what's your tech stack? Like, what's the technology that you're building to build your product? Most tech founders can explain that pretty well. But then is the more important question, which is, what is your AI tech stack? And if you have an investor who's asking you what your AI tech stack is, they know quite a bit about that business already. And so you've got to have an answer that meets their level of scrutiny. If what I just said is brand new to you, what is your AI tech stack? You need to go back and do some homework, because that's where the investment opportunity is now. It's not, hey, we're going to build AI and like, cool, right? Like those days are over. So I'm excited in how people are going to be taking advantage of kind of this next solution. We're seeing some really phenomenal outcome around AI. We're seeing some interesting opportunities as well around cybersecurity and AI. We're looking at AI applications to healthcare. We've made a number of investments in that space already. We're looking at AI applications for a broad range of other markets. I don't want to say it's blue ocean, but it's the water's feeling really good. People should jump in. Question over here.
So let's say I'm managing a car. Do I need an investor to get to the airplane, or do you think it's manageable to get to the airplane based on your slide without any investors?
It depends. Depends on your business. It depends on your market. Depends on your opportunity. Kind of depends on you. Depends whether or not you can convince Lori to invest in your business. Right? Like it depends. So I will answer your question two ways. Here's the first way. No! Screw them. You don't want any investors. Bootstrap your own company. Build your airplane. Don't take anybody's business, anybody's money. Go build it and then sell it. All right. So you sell your business for $20 million. Not a bad exit. And if you own 100% of the company, that's not a bad exit. You take Lori's money. It's your second dilution. You sell the business for $80 million. You're still only making maybe $20 million or less. What do you want? Do you want to go fast? Bigger? But potentially end up back at the end of the game with the same amount of money or less? Or do you want to go a little bit slower? Maybe build, but maybe not as big, and reap that reward yourself. So that's one way of answering it. No! Do it yourself. Yes! Because with her money, you can build a rocket. You know? That could be kind of cool. That could be kind of fun. Yes, you could be bootstrapping it for 12 years and it'll get you this far. But when you take investment dollars, what would have taken you 5 years will now take you 18 months. That's kind of cool. You go from a team of 2 to, who is she? She's been here for 6 months. Wow. How many people do we have on our team now? 80? Wow. When did we hire her 6 months ago? Who else have I not met yet? You know? It's exciting to be part of that growth, but understand that that's the trade-off that you have by taking investment dollars. The minute you take an investor, it's like, okay, ya vámonos, let's go. Let's go. You are on the clock. You need to build, you need to grow, and you need to scale. That's another reason to say yes. Sign me up, I can't wait. That's exactly what I want to do for the next 7-10 years. Awesome. Or, nah, I kind of like my wife, my kids. I like to see them. I kind of like my vacation. I'd like to be able to control my own destiny as a founder. The minute you start taking investment dollars, you need to listen to your board. And your board may fire you. You need to listen to your board. Your board may want to do something different. So there's lots of reasons to say yes or no. You get to choose your own adventure. And I think, and I'll end it with that for everyone on the call and everyone in the room, like, that's why being a founder is awesome. You get to make that call. You get to sit there and say, yes, I want to get that funding, and yes, I want to get investment from you. Or, oh my goodness, I have no other choice. Yes, I'm going to take that investment from you. Or you can say, meh, ni modo. I don't want that. You as the founder have the choice, fundamentally. So understand that as a founder, you get to decide whether or not you want to go right or left, up or down, forward or back. But understand the choices that you're making with investors. That decision is now shared. And in some cases, that decision may be forced. And if you're okay with that, because you understand the game that you're playing, then by all means, let's rack up those balls. Let's see how that game turns out. Great. Any other questions? Well, I think we've gone over. Thank you so much for everyone who stayed. Appreciate it. Thanks for the questions. Thank you.
Sir. Appreciate it. So look, I know that we have thrown a lot of information at you, all of it being very valuable. But there's a few things that I want to make sure that you take away from this is, one, you have the choice and you have many options. What it is that we're trying to do through this program is inform you, connect you, resource you. So no matter where you are in your journey, whether you are truly just beginning, you woke up today, you got an email, it looked interesting, there was free lunch. You're at the very beginning of your journey. Or you're somebody who is a candidate for the Community Health Accelerator because you have something that's ready to go. But you know that you're missing some things, whatever those things may be. Luis may have touched on those throughout the course of his conversation. Jose Padilla last month, whoever it was the month before that. As we talk about the uncertainty in the environments, there's always going to be uncertainty in any environment. You can focus on that all day long, but what I would like for you to do is focus on the certainty. This is a 3-year program, fully funded. We are halfway through the second year. Somebody is going to win that pilot program. There is money available for people who raise their hands, apply to the accelerator, and put themselves in a very intentional position to be informed, to be resourced, to connect. If you're somebody who has an idea and you're entrepreneurially minded, you got the boot camp at the end of April, which is the kickoff to RGV Startup Week. And what's kind of the connective tissue of all of this, and hopefully you're starting to see this, is it's a lot of the same names. UTRGV, BCIC, Velocity Texas, Methodist Healthcare Ministries, and others that are truly trying to align some of this because it's a lot. But if we can start to talk about this in very practical terms, you have a choice, you have options. That's practical terms. You have a choice to show up, connect yourself to Velocity and UTRGV and all of the other partners that we've mentioned to stay informed, right? But if you want to get going, to Luis's point, get going. Because this is a 3-year program that is meant for you. We are here for a reason. We're here to connect with you, to help to plant seeds, so when you start to see and already have seen future industry developing around you, you don't feel as though you don't have a place in that space, to use a pun, right? These programs, if we don't understand how to use them to our benefit, by and large just go away. And one of the things that I want to make sure that kind of rings loud and clear, because it is the focus of the programming, is that we are trying to build sustainable enterprise. Which means that your company runs based upon customers and revenue, not donations and grants. Just asking you to build business, right? As simple as that sounds, it is very complex. And that's why there is as many seminar series and boot camps and accelerators and very intentional efforts to try to help usher you through the process that typically requires an assembly of talent. that is assembled over a period of time and inflection points and decision points on, I'm building a bike right now, is my next logical place an airplane or a rocket? Who is in my atmosphere and who can make those things happen based upon my choice and my optionality? Because you know what? I was fortunate enough to attend a speaker seminar series of Luis Martinez that said, hey man, it's my choice. And more importantly, understand the choice I'm getting ready to make. We would want nothing more than to see this program get renewed year over year over year, because again, for Methodist Healthcare Ministries, the more that you learn about SDOH, which are the Social Determinants of Health, there's so much that happens outside of the hospital system that affects the total span of care and the cost to healthcare, period. But if we're not thinking about it in that way, then yes, we are spinning up new AI and putting additional wrappers around ChatGPT, not those kinds of wrappers, but wrappers, okay? We're innovating in spaces that don't necessarily require, need, want, and all the while there's just this huge demand and need over here, and there's capital partners saying, hey, look, if you participate, we'll fund this. And we'll utilize our resources to make sure that you're in a position to try to create a sustained enterprise. There's nothing wrong with making money doing good work. And this is the beauty of the program. What I wanted to make sure that we used is just a very quick functional example, because again, like, what does it mean to you? What does it mean to me? Like, we've thrown a lot of language out, and there's a lot that's involved in this program, but truly, what does it mean to me? So I'm going to pick on the two of you, Jose and Juan. By the way, thank you for being here. Own a gym here in Weslaco by the name of Top Gym. So when you're thinking like, well, what is it that I can do to participate in this program? To somehow be competitive for that money or that resourcing, I own a gym. I'm not doing what I think this work is. Well, earlier, your ChatGPT interrupted us, right? This is the AI use. That if you're not in a position to go build new AI, or it's overinvested, it is how are you using AI to innovate your business? So a simple prompt into chat, just put it in, I'll share it with you. If I owned a gym, what would be a good innovation in social determinants of health that I could focus on if I wanted to create a sustainable business around that opportunity, using my gym as the source of business for that innovation? And what did it do? What it always does. It spit out an answer. Okay? So, I could send it to you. You can do this yourself. Now, the thing that you need to pay attention to is it spits out a plan, but the plan that it spits out is highly dependent upon grant-based funding. Because again, the machine doesn't know. So as I got through the plan, I said, oh crap, this is a grant-based funded idea. I said, I need the business to be sustainable through external factors that do not include grants or donations. It needs to be sustained on revenue. What did it do? It iterated the plan. Here's how you can use your gym to drive more revenue related to SDOH. You already have a business, which means that you probably have a legal entity and a P&L and accounting and a customer base, right? Like, you may not see yourself in this program, but you're exactly who this program is made for. It's not just doctors and nurses and lawyers and folks who say, hey, look, you're in healthcare and I'm not in healthcare. In SDOH terms, we're all in healthcare. And that's the thing that we've been trying to kind of break through with this whole deal. And it's great that we're starting to see some of the same folks. Joaquin, recognize your face. David Wright, like, I'm glad to see some of the same faces here. And it's always beautiful to see new faces, whether here or online. But if you can help us carry that message forward. Hey, I was here, I picked up 2, 3, 4 really great pieces of information, and oh crap, I didn't think about this, but I can utilize my business to participate in this thing. And even if you didn't make that decision, you got somebody who's in your ecosystem where you're like, hey man, this is perfect for so-and-so. no matter what stage of the game, because again, there's a solution for everybody. These speaker series are meant to speak at kind of a high level, right? Boot camp, starting to bring you in. Accelerator, it's go time. And all of the resources that the partners are providing in between. RGV Startup Week, y más, okay? So, I know that we ran long. I do appreciate you sticking in there with us because you really are our champions. You are here. You will talk to your sphere of influence about the impression that we left with you, okay? And I hope that it was a good one. More importantly, I hope it was an informed one. There will be a survey that is sent out directly after, okay? Look, it's hard to do this and try to connect to a community absent there being a feedback loop, okay? Elsewise, it's just us talking and maybe hitting the mark. But when we hear from you, it really helps us to refine the program because it is intended for you and for the members of your community. So I would encourage you to participate. There's a couple of links that are going to be on that survey and or messaged in that as well since you're in the room, and if you're still with us online, if you could go back to the accelerator really quick. Okay, we talked about the accelerator being a very important component of this program. So if you are a high potential startup addressing SDOH with something that's ready to go, you've got a team that has proven traction, and you're interested in the kind of help that we've been talking about, please scan this QR code. Applications are now open. They will close, I can't read that, June 16th. Speaking of June 16th, if you go to the next slide, for those who, and Luis had mentioned this, dual use, military dual use, this is a conference that is specifically designed to connect industry to the military, and then with some academic support as well. So again, if you are interested in innovating in the military space and or a dual use space, I would encourage you to go to this summit. It's in San Antonio. If you are a student, it's free. If you're part of the military or government, it's free. If you're an industry partner, I think it's around $150. It's a very low cost of entry to have that kind of attention with military and academia. Next one, for those who know Biomed SA in San Antonio, they have an event called BioFest Invest Days, round about the Fiesta time period. I think it's around 5 days, multiple events. This particular event is by one of the aligned partners to Velocity Healthcare think tank. They're going to be doing something very special with BioBridge Global that they haven't messaged out yet. I'm just giving you a little bit of a precursor. There's going to be something very special relative to cancer care treatment that is introduced during this particular event. Again, if you're in San Antonio or have plans to go, I would not only attend this event, certainly get interested about Biomed and BioFest Invest Days. So, thank you very much. Last but last, connect to the people who are in this room, okay? Connect to the Velocity assets on social, MHMs, UTRGV, sure, but I'm saying connect to each other. You are members of the community. We are here for you. We're going to hang back, do some networking. Again, thank you so much, and we will see you on our next visit in late April. In late April. Thank you.